Alrighty. Okay. Let's get started with no mantra. Om Namo Arihantanam. Om Namo Siddhanam. Om Namo Ayariyanam. Om Namo Guvajayanam. Namo Loe Savasahunam. Eso Panchanamo Karo. Sauva Pavapanasano. Mangalanancha Sauvesim. Padamam Havai Mangalam. Padamam Havai Mangalam. Hey, come on in, come on in.
I'm cold.
You're cold?
We don't
Your
have
dad
a
has
choice.
a jacket. Oh,
This is my white coat.
oh,
That's even better.
that's even better. It's going to serve as a blanket, right?
Yeah.
It looks like it's daddy.
All right. Well, welcome everybody back to the Dad's class. I'm Paresh, filling in for Tim. Most of you all know me, but for those who don't, I'm a professional money manager, and I have my own firm. I manage money for individuals, small businesses. We basically help folks achieve their investment goals. It's a passion with me. I try to do this as diligently as I can, day in and day out. When Tim asked me to kind of lead the discussion, I was happy to do it, but I did it because I have enormous respect for Tim, and you know, there are some issues that I obviously have disagreements with him, and I let that know in the class. But I think it's what he does is tremendous, and there are some things that he's helped me understand that I would not have otherwise understood. So I'm very very grateful to him for doing this. All right. So as I said, we're going to be discussing money and finance, and it's going to be a discussion. So I'm not here to preach anything. Just an open-ended discussion. I actually was thinking what I'll do is I'll start off with sharing with you all my experiences and what I have learned over the 25 plus years of my career, and then we'll just let it flow the way it goes. Yeah. So as I said, it's my lessons, and the first one is that I am still a student. Okay, investments is such a vast and fluid area that nobody can ever claim, actually in my personal view, to know everything. It's a constant learning process. You learn new things, and so I have come to realize that I'm a student and I learn, and my objective is never to consider myself a master, and be receptive and keep that process going. One of the surest ways that you know that you're a student is that when you make a mistake, and like many investment professionals, I make mistakes too, even today. So that's one of the biggest things for me is not to consider myself master, just be a student and keep learning. So, if anybody has any questions or any comments or any inputs, please feel free to jump in at any time. Number two, as I was talking about mistakes. So I have observed in my career, people tend to take mistakes more seriously than their successes. So, when you make a mistake, people beat themselves up. They say, "Oh, why did I do this?" Whether it is actually buying an idea or not buying an idea, right? Why did I do this? What I think helps investor actually be a better investor is to be balanced. You should take the learnings from your mistakes, but at the same time, the learnings from your successes are also important. What worked, why it worked, is equally important as to what didn't work and why it didn't work. Because focusing just on the negatives actually makes you a less positive investor and makes you miss opportunities that you otherwise would have been more receptive to. Okay, there's a whole area in finance called behavioral finance. And I'm not going to go into that, but it actually is a vast area. They go into the psychological aspects of how investors behave, how their experiences tend to influence their decisions, and investors typically focus on the negatives more than the positives. That's what the research has indicated. So that's one thing I think I have tried to not let negative events, negative experiences, negative ideas, or my mistakes overtake the positive ones. Keep it balanced, and I think you'll find the results are better.
And I think that rule applies to mostly anything what we do every day, right?
Right.
Whatever you're doing, finance items, you have positives, you have success, and you have negative. Human nature by itself is you keep living in that negativity longer.
Yeah.
You gave an interview and 9 out of 10 went really well, one did not, and you keep stick on that one piece.
Yeah.
How did that happen, right? So that's a human tendency, but that's a very good lessons to put it across and keep reminding yourself.
Yeah.
Yeah, but that's also high level because you step down a notch further. The very first thing you either gave the interview or you invested is you thought positively about it. Now when you're trying to dig deeper and see, okay, what's good, what's bad.
Right.
At that time, it's the evaluation phase. So I don't know. Perhaps it's okay to consider the negative points, but I do see your point in terms of what is the don't try to be always pessimistic.
Yeah. Right. It's got to be balanced. That's the point I'm making. It's got to be balanced. The point I guess I was trying to make is from an investing standpoint, since money is involved, investors tend to be there's a concept called disposition. You tend to focus more on capital preservation, and you tend to, for example, hold on to your losses and quick to take profits. It's a tendency. It's a human tendency. Whatever people think, it'll come back, and I don't want to take losses. I've seen before things bounce back. Those kinds of things hinder an investor's ability to make rational decisions. An investment has to be judged, and I'm kind of deviating now, but has to be judged on the merits, not whether you think it's going to come back and not come back. If the thesis is valid, it is valid. If it is not valid, it is not valid. You gotta be out. Price has no But I see your point. I mean, the fact that you get in, yeah, it's a positive that you're focusing on, and I will, yeah, I think that's true. All right. The fourth one is respect the markets. I have learned in the initial at the start of my career, I always thought market is participants, all people who come to the market and indulge in investments, and so all you have to do is be smarter than the rest, and you'll make money. Well, over the years, it turns out that that approach or that thinking is not what I found out to be correct. Markets, you have to have a very healthy respect for the market. The collective wisdom is important. Uh, you can't be dueling it out. Market gives opportunity for everybody at any given point in time. Respect that, take the opportunity. Sometimes you will succeed, sometimes you won't succeed. And just, to perceive it as an entity that you're dueling against is not necessarily a good way of looking at it. Respect it. It's like in businesses, especially we Indians, we have the Lakshmi Pujan and the Chopra Pujan, and at least when I used to go to my dad's office when I was young, we were taught to respect the business. It's like our Annadata.
Correct.
Respect it. It's going to give you opportunities. Take it. Don't be bitter. Don't try to have ill feelings, and just be a participant at your level. You're not going to be able to do everything. You're not going to be successful all the time. You're not going to beat the market all the time. It's a psychological makeup, how you perceive it. And I've learned that just being respectful of the market is for my psyche a good thing. It makes me a more calmer investor, a more satisfied investor. You're thoughtful. You have a question?
No.
You have a comment? No?
He wants to make money.
So, you sometimes wonder, well, 25 years ago, some people will say, hey, I give my money to, but you probably won't like this comment, but why would I give it to a third party to invest my money? In this day and age, all the tools, the access to your brokerage, right? Online trading is available, but you just made a very good point. We as individuals sometimes may not practice those principles. It's a person that is, who's a participant, who knows that, has more an applied way of rationalizing the markets versus us who are new and make harsh decisions, like you say, holding on to our losses and whatnot. Probably a good reason why.
Yeah, these are very important points you bring up. I mean, it's not a pitch for investment managers, but that's the only reason you pay managers, is to avoid the mistakes that you as individual investors would make, right? The idea of balance sheets and income statements and cash flows and EPS and P, those are really okay. Those are measures, those are indicators, and managers look at all these things. But what is most important in my personal view is that you have a manager who does not get emotionally swayed by markets. I mean, and markets are tough these days, especially it's because of these tools and the technology that has come into play. You've got volatility that's huge these days. Things move crazily, and to maintain one's composure, calmness, the focus of long term, those are the only reasons I think you justify paying an investment manager, quite frankly. But yeah, those are very, very, very valid points. The other thing I've learned is that markets are never right or wrong. Markets are markets. It's the investors who are right or wrong. Nasdaq was at 5,000 in year 2000. It subsequently went down to 2,000 in 2009, and now it's about 9,000. So, was was market wrong in 2000? Was market wrong in 2009? Is market wrong now? No. In my view, markets are markets. It's like a lifeless entity. It's there. Participants can make a decision at that point, and they have to there has to be a reason for the decisions that they make. But you can't say the market is wrong or the market was wrong and I am right, and it can't be a us versus them again mentality. Opportunities in year 2000 were on the sell side. The market gave you that opportunity to sell. Cisco was at above $100. Okay. Today there are opportunities to sell as well. It's up to the investors to decide what they want to do. Can't blame the market for the decisions and investors that an investor makes. It's actually very important psychologically, if you think about it, to understand that you are dealing with something that is totally unbiased, totally emotional, right? Markets are not emotional, investors are. That's what drives the prices up and down. But you're dealing with a completely lifeless entity here when we talk about financial markets. Number 5, and that leads me to the next point: know what type of an investor you are. There are hundreds of ways of making money in the market. You've got hedge funds who use artificial intelligence now. They're focused on all kinds of factor investing is there. There are investors who use technicals to make money. There are day traders. There are institutions who have a long-term orientation. There are multiple investors in the marketplace with multiple objectives. And this is interesting. Germany's 10-year government bond has a negative yield of about 20 basis points. So you would think, who in their right mind would say, yeah, I want to invest in a German 10-year government bond that is guaranteed to make a loss for me. It's guaranteed. You buy that bond, you're guaranteed to make a loss. But there are investors who are buying that, and there may be institutions who have mandates. So there are certain institutions, pension funds in particular, who have certain mandates. So they will say 20% of their investments have to be in fixed income, and out of those 20%, they will appoint managers, and some of them will have index that they are benchmarked against, which has government bonds. And if they don't buy that, they are opening themselves up to massive questions later on. Well, you were supposed to be benchmarked against that index. You didn't buy it. Give us the reason. And if it goes from negative 20 to negative 50, you suddenly are in a hot seat. So a lot of these things, I mention it because you have to know what type of an investor you are, how do you deal with volatility. A lot of investors don't like even a slight dip in their portfolios, it makes them very nervous. It makes them very edgy. It's they lose confidence in the concept itself at times. When you have a big dip like we had in 2008, people said, "Oh, this is all rigged. This is completely manipulated by the big boys. I'm not playing this." They got out, and we're discussing investments
Oh, okay.
and my experiences in the marketplace.
Oh,
Okay, so feel free to jump in anytime.
okay.
Yeah, so people who got really scared or bitter about what happened in 2008, got out, have lost out in the best decade for investments by far. I mean, from 2009 to 2019 now, it's been just an amazing 10 years. If I mean, S&P from about 666, that was a number at the low, 666, the devil's number, right? 666, it's over, what is it, 3,000 now? Or somewhere there. It's incredible what a run it has had. But my point is, know what type of an investor you are. At least I have learned that I'm a very long-term oriented, patient, fundamentally driven investor. And I like to invest with a very long-term orientation. I'm not a short-term investor. I don't take short-term positions. I'm very uncomfortable trying to play events. This company has results getting declared tomorrow. Let's see, I think it's going to do well. Let's buy something and sell it. But that's not what we do, or at least that's not the type of investor I am. But it works for some people, okay? I'm not going to say it doesn't. It works for some people. These are your active daily traders who take these positions. They are there for a day or two, maybe even less. They're out. All power to them. But for those investors, they have their own set of disciplines that they observe, and that's what makes them also successful, actually. So whatever type of investor you are, just be aware of what type of investor you are and what the expectations are, given that orientation. The next one is, I've learned to give due consideration to all ideas. At the start of my career, I was like, "Oh, this is not good." Oh, somebody would mention another, like, "You don't know anything. I know much more." Maybe it's the age, maybe it's the beating that I've taken at times, but I've kind of realized that there is no bad idea. Okay. There are only bad calls that investors make. No idea is bad. Every idea needs to be given due consideration. You may act on it, you may not act on it, but don't dismiss it. What may be considered radical or really fringe at one time could be actually the idea of the decade. People dismissed Amazon in the early 90s as something that's not going to work, and look at where it is today. So I try my best to never dismiss any idea. I give it due consideration. I might not act on it, but be humble. It's one thing that carries you well in the investment world, because you're going to be finding out at some point or the other that your idea was not the right idea, and at that time you're going to be faced with the reality that your ideas are not the only ideas that work. Other people's ideas also work. So be open. The other one is, speaking of ideas, and this is probably the hardest part of my job, is to assess, and I said due consideration, and when I do give due consideration, uh, the ideas that are not working, the ideas that are working are easy. You let it ride. It's working. It's going up. I'm smart. But the ideas that are not working, assessing those ideas and making a call on those are really difficult. Really, really difficult. They challenge you intellectually. They challenge you ethically also. And they challenge you in a very humble way. In other words, are you being honest with yourself or not? It's not working, okay? And I'll if you're in the energy sector, you know what that means when things are not, things haven't been working for last 5 years. So you face up to it and you assess it and you say, am I supposed to be in this or not? And there is no standard formula as to how you arrive at a conclusion. But be honest to yourself, I think works really, really well. If you believe, if you've done your work, if you've looked at it really thoroughly, and you come to the conclusion that it's not the right thing to be in, accept it. Don't run away from it. Just there is no glory in deceiving yourself. Let me just put it that way. Be very, very candid. If you arrive at a decision that it's not working, it's not working. But assessing that those kind of situations is the hardest part of my job. It really is. I spend a tremendous amount of time and energy when I'm faced with those situations. It actually is very draining. But hey, it's part of any profession. There are aspects of any profession that drain you. But you have to face them. You have to learn and deal with them. And that's I put it in there because I think that aspect is the toughest part. Okay. A last couple of points I'm going to make, and these are more general, and these are kind of the sayings in the market. Okay. So the first one is this one from John Templeton. He's a legendary investor in the investment world. The fund house Templeton funds. That was his. So he said, bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria, which is, I try to keep that in mind all the time when I'm looking at the macro picture. I get this question asked all the time. Hey, we are 10 years in the bull market. What do you think? Are we due for a big correction? And my answer to that is really that bull markets don't die of old age. They die on euphoria. I don't see much euphoria. Euphoria is typically associated with bubbles, okay? Generally speaking, not necessarily, but generally speaking. And a good way of being cautious is when you see bubbles forming. Whether it was the tech bubble in 2000, and again, this is hindsight, so it's easy to spot, right? It's not easy to spot when the actual event is occurring, but tech bubble in 2000, housing bubble in 2008. My sense is we are in a bubble, not yet a fully formed bubble, but in the initial stages of fixed income bubble. Rates are extremely low, very, very low, and this has been going on for a very long time. So probably that's the area we are going to have problems in when we do get there. But right now we are not. So I think we are okay at this point. But that's a quote from Sir Templeton that I try to keep in mind. The other one, and this is a shameless plug for capitalism. Okay, I am my profession directly deals with capitalism, and so I'm a capitalist through and through. I believe in it, and so this one comes from Winston Churchill, and I also I I I, I say this because these days socialism seems to be kind of getting some sort of attraction, especially with millennials. Okay, and so those of us who have lived through socialism, you know, some of us have come from India, we have lived there, we have seen what it is like. This is something for us to keep in mind. The inherent vice of capitalism is unequal sharing of blessings. The inherent vice of socialism is the equal sharing of miseries. Okay, it's Churchill said this a long time ago, and I think it's very, very relevant. All right.
Can you repeat it one more time, please?
Sure, happy to. The inherent vice of capitalism is the unequal sharing of blessings. The inherent vice of socialism is the equal sharing of miseries.
It's very interesting that Winston Churchill, I mean, one of the leaders who was considered, has said it, and he's one of the pioneers, right?
Yeah.
I mean, of the U.S. I don't know much about, but U.S. in general, so the economy is part of it, right? So.
Right. Well, he was the Prime Minister of UK.
Oh, okay.
Yeah.
Sorry.
And he was very instrumental in World War II. So yeah, but he, you know, I interestingly he lost his re-election bid after the World War. It was one of the most amazing outcomes at that time. People thought, you know, it's Churchill, right? It's Churchill.
What's interesting is he's saying, I mean, basically he's making case for unequal sharing of the blessings, right? And as you said, rightly said earlier, that it's a plug for capitalism, and that's what it is about. It's because it makes me wonder sometimes, you know, like oil and gas companies go drill in Nigeria, Africa, and those resources, and obviously they try to do something for them, but at the end of the day, the investor in U.S. is making money for drilling in the Africa or anywhere else in the world, which is exactly what it is, unequal sharing of blessings, because obviously they're getting a piece, but probably a minute piece of this blessing that they have underneath, and more, maybe taking a lot more of the bad side of it, which is so obviously somebody, a pioneer of world UK in this case, saying that obviously is inherent in the business that's developed over years.
Yeah, I think it's a great point, and there is argument to be made that you know, companies need to be more socially responsible, and I think that they are to a large extent taking that. You know, you don't, you know, for example, they take their environmental responsibilities a lot more seriously these days than they were previously, you know, and it's a good thing. But at the same time, you know, it's these kinds of the idea of unequal sharing, okay, is a concept that capitalists urge other people to embrace. So why would that be? I mean, my personal view, the idea of equal sharing is just not going to work. The degree of unequal sharing we can debate, but if you're going to employ a capitalist system, you know, Nigeria, for example, it's inviting tenders, right? It's inviting worldwide tenders. Companies from all over the world bid for it. There are terms, there are rules, there are regulations that they have to follow. There's clear, Nigeria clearly thinks it's in their best interest to invite these companies bid for the tenders, and conduct business there. I mean, it's something that they want to do, and they have accepted the unequal sharing of blessings. And I think it's healthy for people to embrace and accept that capitalism is not designed for equal sharing. That's what communism and socialism tried to do and failed miserably, very miserably. I mean, very bad consequences. It's documented. We don't have to make numbers up. How many people lost their lives in Soviet Russia? It's incredible, and China, by the way. So, and I see the point about unequal distribution, but we have to embrace it. Otherwise, it's going to be always feeding this ill will against a system, and it's not. I don't think it's going to be helpful to either Nigeria or look. Nigerian people are better off that Exxon and Chevron are there doing business as opposed to warlords taking over the resources, which is what is happening in a lot of these places, and basically looting for their personal gains. But it's an important point. I think it's getting more and more attention.
What I think on the other side, and again, I'm not against capitalism. I think that works better than, and you have to always go for the efficient system versus less efficient. But what I've also seen by doing so, what happens, you create almost, whether we call it or not, in India we used to call it caste system. And here also, in US, you have social societies. You have the people who are rich, filthy rich, and then rich and the other, and multiple different levels. And when we think from Jainism standpoint, right, what's going to happen is you have somebody who is very poor, and you have somebody that's filthy rich. So the mindset have an effect on it, and then these differences can also create other social issues, which can, when especially the gap goes widen. That's why they talk about, the gap between the rich and the poor should not be as far, and especially when the capitalist goes to an extreme level, that's when it's going to happen. The rich is going to be richer and richer, and the poor is going to be poorer and poorer. In a way.
How's that? Why would you make that contention?
The reason or at least in my mind, what happens is that people like Warren Buffett and things like that, right, who has ability to throw in a big weight, even if the market goes down, they're going to be okay. I think they will support themselves with the either the smartness or their weightage in different markets. Whereas somebody who has even no exposure or a little bit of exposure may have a larger effect to the lifestyle. And when that happens, that, for example, I remember 93 riots in Mumbai. I mean, people were trying to somebody who's filthy rich and somebody's poor is like, okay, I'm going to protect you, and you have to pay me the tax. And after that, it became almost like that. All the riches or builders and things like that had to start paying. They're like, oh yeah, they're wanting to do this. They're wanting to pay the tax to protect them. So, and again, I'm kind of comparing two different things, but
yeah.
It is capitalism on extreme, as I'm talking about, which is, I don't think it's the case yet.
That's look, regulation of any system is needed. Nobody, at least I don't advocate laissez-faire, like anybody do whatever. You have to have rules, you have to have regulations, and everybody has to follow those rules and regulations. So if, for example, somebody is indulging in insider trading and trying to extract illegal gains from this system, they should be not only apprehended, but they could be put to jail. Nobody is advocating for laissez-faire. At least I don't. Okay. The thing about the extremes that you mentioned, Warren Buffett, and I'm not a advocate of using filthy rich. You know, they are decent rich people. Okay, they happen to be rich, and they do really good work. By the way, Microsoft's Bill Gates
he
has
does
a
lot of
foundation, and he does a lot of work in India. A lot of work in India, and he's helping a lot of people. And Warren Buffett is pledged to give all his wealth away to Bill Gates Foundation. A lot of these rich people do a lot of good work. I actually don't resent them at all. I'm glad they are doing what they are doing. They probably do a better job than governments do.
Oh, that's Bill Gates definitely, and Warren Buffett. I mean, I use that word because we all know about it, but there are billionaires that we don't even know about, they are not as forthcoming in the social responsibility as Bill Gates or Warren Buffett, or in fact, as young as he is, the Facebook guy,
Mark
Zuckerberg. He's doing that as well. In fact, he created a foundation pretty early, and that was a talk. And I somehow, with the millennials, as you mentioned earlier, the social responsibility. I mean, working for an energy company, we're just starting to talk about social responsibility and carbon emissions. I mean, it's been known for years since we've been doing the business, but now it's the reason it's required, because it's the requirement to do the business. It's because people have taken the initiative. It's driven by, I mean, even Exxon until this point. I mean, we're in the denial phase in the UK. Our company picked up earlier because of in France you can't do a business because you just. So what I'm saying is, it's great that we're starting now, but it's in a wake of a lot of protest from social side and social responsibility, which is I think it's a great start, late but good start.
Yeah. There's a guy called Simon Lack. He runs a firm called SL Advisors from he's in New Jersey. He does a lot of work on energy. He's actually an energy investor. He runs mutual funds. He runs funds focused on energy, just energy. Okay. And he talks a lot about climate change and the effect of climate change, and how energy companies, energy investors need to respond. He's actually sympathetic. I mean, as you mentioned, most of people in the energy industry and energy world tend to dismiss climate change concern, but he's very sympathetic. But he says, and again, I'm not saying you're advocating this, but he points out that the more radical and more extreme elements of the climate change movement have taken over this whole movement. And what is happening is that it's repulsing general people, common people, and it's not a good thing. We know that from experiences in the other areas. When extremism comes in, it always backfires, and so these concerns are valid concerns, and they need a very thoughtful and a very nuanced, very mature responses. But I find there's a group called Extinction Rebellion in UK. The other day, just to make a point, their activists jumped on a train. This is commuting time, 9 o'clock, prime commuting time in UK, and they disrupted the whole train system to make a point that enough is not being done on climate issues. Now there are people who need to get to work. Their jobs could be online. They have to feed their families. I mean, if you want to make a point, but you can't be disrupting the lives of people like that. they drag these people down from the train and actually, physically drag them out of the station. So it's the point in telling you all this is yes, millennials have brought this issue to the fore, which is a good thing, but we need very thoughtful minds and we need thoughtful responses. By the way, CO2 emissions in the US are at the lowest points they have ever been in the history of the United States. And he's got data. He's saying we are by far the most active and the most effective country on this planet when it comes to climate change. And what we are doing is by far leaps and bounds ahead of any other country. And yet, our companies and our sectors are being targeted the most. It's because we are an open society. We entertain, all
I
kinds of
think part of the
views.
reason also is because we are consumers of what's being made in China. We pushed everything or the manufacturing in China. So that's part of the reason why the emissions are lower. I mean, today you go to apply for permits to okay, you're creating like 1,000+ jobs and you want to build a brand new refinery. You're not going to get it at all. Because of the regulations in general, but bunch of other factors too. So that's part of the reason also why. But yet, with our or borrowed dollars, we are still supporting the industries and what's being manufactured out of China.
I don't know if we actually pushed, but it's the capitalist system, right? Capital
It
flows,
is.
capital
Right.
flows where the returns are justified. I mean, today it's China, tomorrow it could be Vietnam,
It's
and
already happening
it's
all
already
across
happening.
countries, yeah.
I read a lot about the migration from China to other countries. But I think your larger point is, U.S. consumers will consume irrespective of where it's produced, whether it is China or India or Vietnam, or if it's produced even in the U.S., they are going to consume. I mean, somebody is filling the need. China is not doing it out of
Yeah,
their-
that was just an
it's not
example,
a social.
yeah.
It's not a charity that they are doing. They want those
Right,
jobs
right.
created there. They are fighting for those jobs.
Yeah.
As a matter of fact, they are fighting for U.S. companies to be there and European companies for that matter. Look, my point only in bringing this up is we need thoughtful responses. In my personal view, you have to be nuanced. You have to be balanced. You can't take things out of context, out of control. And if you make a thoughtful case, I think people will listen. People listen. But if you're just going to, be extreme about things, I think people just tune you off.
Yeah, I agree on all that, but at the same time, yet these very companies, they don't necessarily support one way or the other. And just from my standpoint, I mean, these days, anything that we buy, like vehicle or washing machine, microwave, whatever, it has a life of 5 years. Like you rewind back to 15-20 years back, they had a life of 30 years, but now that's a new way of making money. But what's the collateral damage, right? I mean, to the environment, to a bunch of other things. We're taking this whole piece and it's trash, it's garbage, right? That's contributing to a lot of environmental issues. So
I hear that.
unfortunately, nothing can be done about
It's
that.
it's so true, and that's one of my pet peeves as well, because they call it demand creation, and I think as we as engineers, you have required life. You give your customer 1 year warranty on your washing machine, right? At the most, you want to make sure it lasts for 2 years, and it dies in 2 years. So there's somebody's buying a new machine, so you can. I mean, it's same dishwasher. I mean, it's amazing. In a new neighborhood that we guys live in, I mean, every time you'll see somebody, oh, my dishwasher is broken, my washing machine is broken. I lived in a house that was built in 2002, I believe, in Beaumont. 10 years. I mean, it's just like you oil your machines and change your filters and it's fine. Nowadays, it's almost, and there's no guilt if you go tell them, oh, it broken in 2 years. Oh yeah, you only had 1 year warranty. You should have bought an extended warranty.
Mm.
Because nobody, if you know that it's gonna life is 15 years, you won't buy extended warranties. Now we're willing to buy extended warranties, or we need more. I call it a demand creation.
Yeah.
So just by design, you want to create those things to fail, so that you need new stuff.
So not being
Okay.
extremist about it, but if the thought process is such that that's fine, you want to rotate money, you want to create demand, and you want to help economies, whatever, then how can you use sustainable or recyclable materials in that? What are the pieces, what can be done, and then upfront say that this has a shelf life of 3 or 5 years, at the most it can be +2, +3 years, and it's priced accordingly.
Yeah, but if you
Fine.
think about 15 years ago, the technology what we had, the features what we get now versus 15 years ago, amount of water usage compared to the old machine versus
Okay.
new efficiencies, right? And the price break. So the computer 20 years ago, the computer price, what you can get,
True, very true.
right? So I was at NASA and I was looking at it when the first time they put the Apollo 11 was the first time it hit the moon. The technology what they use, this phone has 10,000 more powerful processing unit
Wow.
than that technology what they put the
Absolutely, yes.
Apollo 11, right? So I mean, something to give and take. Technology wise, we have come far ahead in last 15-20 years. Efficiencies wise, and for the environment, all this data what we see, all this things that we offer to save the planet, whatever we want to call it, I think this is the time to do it too. I mean, this is the time we can offer that too, and it is being done. It is being done by all the oil and gas companies if they want to stay in the business. So yes, they want to take the biggest piece on the rewards. At the same time, they have to play by the rules. Not only here. If there is a labor issue in China, that creates a problem for Apple here,
Mhm.
right? The stock clearly impacts by if you use bad labor or child labor or something, those report comes out. So they are even following these additional imposed rules wherever their footprints are. So yeah, that's part of the capitalism.
And one last point on this. The demand for a certain idea or a product or a service, if there is enough demand, there will be capital that goes into that idea. So, for example, there is something called ESG investing now. It's environmental social governance. These investors invest only in companies that are fitting the criteria of ESG.
Yeah, there's a score.
Yeah, there's a score. Exactly, there is a score. In fact, there's an index.
Yeah.
So if there is, and last year, now I may be getting these numbers wrong, but last year ESG funds attracted close to, I want to say, $10 billion. I think it's even more. So if there is a demand, if you say, I only want a washing machine made out of recyclable parts, if there is enough demand, trust me, capital will flow there and somebody is going to produce
I
it.
don't doubt it.
Yeah.
Absolutely.
Okay, that's what capitalism does. If there is enough buy-in, you will get a product that is going to satisfy your need, and it's the most liberating thing, I think, in my view. You can't force anybody to do anything. It's what the marketplace provides, and if there is demand, there will be more. But hey guys, listen, I think we're getting to the end. I just couple of trivia questions to end this. I thought would be good. Okay. So the beginning of the stock markets, nobody, it's traced to actually the charters given by UK and European governments to East India Company.
Mm.
Okay. Investors or people who were financing East India Company's ventures everywhere in the world were given promissory notes.
Right.
And they would be selling and buying these promissory notes at a premium, and they were making money. That was kind of the beginnings of this public ownership of of enterprises. So um, the first bubble following up on that was a company called South Seas Company. They looked at what East India Company was doing and they said, oh, we can do this. So they issued a lot of promissory notes, but it was all fake. So when the time came to pay up, they couldn't. They collapsed. That was the first bubble. Okay. Anybody know what the first stock exchange was?
London maybe?
Yes, it was the London Stock Exchange. What anybody know what the first U.S. stock exchange was? And when? No, it was actually Philadelphia, 1790. NYSE came 2 years later, but it's obviously become more prominent and it's a much more famous now. And last one, what is the oldest stock exchange of Asia?
Indian.
I think it's Baroda.
Bombay
if I'm not
Stock
wrong.
Exchange.
It's Bombay Stock Exchange.
Bombay?
1855.
Oh wow.
Actually, if you go, I was in BSc. I started my career there. If you go, they have the older people will they will always point to that. Hey, that was where the banyan tree was, and we would stand there and or their ancestors would stand there and conduct business. Hey.
Conduct the business
Yeah.
under the tree.
Hey,
Nice.
thanks guys. Thanks. Appreciate
you.
your.
Very, very good.
Thank you.
Appreciate it.